Perfect. Hello. Hi everyone, we're just waiting for a few more participants, and then once we've got the participants in, we'll get started with the presentation. Okay, so I think we're good to get going now. So hello and welcome to our AREF presentation on how to tokenize an asset. Today we're going to look at tokenization technology and how it can be used within the real estate industry. And this is a follow-on from our previous presentation that we had back in February 2020. So it's been a while since we followed on from this, but we've finally got around to offering a follow-up presentation on tokenization. I'm Vicky Dalziel and I work in the real estate product strategy and investment specialist team at Aberdeen Standard Investments. And I have a specific interest in understanding how the real estate industry can use tokenization, whether that's at an asset level or a fund level. I think it will be good to learn, and that's what we're hoping to cover today. So we have three presentations lined up. We have Claus, who will speak first, and he is the CEO at Digishares, and he's going to cover the tokenization within the real estate industry. Following on from this, we'll have a presentation from our very own Charles Kerrigan, who's also a part of the AREF, part of our AREF group, and he's going to present with Alan on the legal and regulatory framework. And then finally, last but not least, we'll be having a presentation from Attendee, who is the CEO of Applied Blockchain. He's going to speak to us about his experiences within tokenization and the fintech industry, which I think there's quite a lot of learning that the real estate industry can do from. So following the presentations, once we've had our three excellent presentations, we will be moving into a Q&A session. So I've been told to let you know that you're able to share questions through the Q&A function on Zoom, and these will only be shared with the speakers. So we will collate all these and then ask them during our panel session. So please do send those throughout the presentation, anything that you may have. And just final bit of housekeeping, just let you know this presentation will be recorded and available. So if there's somebody who's not able to make the presentation today in your industry or business that you think would be interested, please do feel free to share the link later on. So just moving on, we'll start with our first presentation from Claus. So please feel free to get started when you're ready, Claus.
Thank you. I'm ready now. My name is Claus Skaaning. I'm the CEO of Digishares. So Digishares is basically a platform provider in the space. We've got around 20 projects ongoing around the world. Our focus is on real estate tokenization, and I will give like a general introduction to the space and also speak about the steps required to undertake a tokenization project. Next slide. Yeah, so briefly about me, I have a background as a researcher originally, PhD in computer science, but I quite quickly left the academic world and started working on the business side and started several companies, including a few in the AI space, but sort of with a focus on blockchain since the last 4 or 5 years, and CEO of Tdcs since 2017. Let's have the next slide. Digishares, very briefly about the company. We provide a platform end-to-end solution for tokenization of real estate assets. The The platform has functionality in different areas, both related to the financing of different projects, corporate management of ongoing ownership structure and projects, and also trading. There's a built-in marketplace that allows investors to trade in a peer-to-peer fashion. So basically, real estate developers sign up with us in order to get increased liquidity, to reduce administrative costs, and also to reach other types of investors. Let's have the next slide. So what we see in the real estate market space right now is that there is a lot of paper-based, complicated, time-consuming processes that are ripe for automation and digitization. The real estate space is also extremely illiquid. Very small percentage of the market is actually traded and available for real estate investors to invest into. Normally, the ticket size is also too high for a lot of people to participate in real estate investments, and there's also a lack of transparency. All of this is something that tokenization can assist with. It can help increase or create large reduction of administrative costs through digitization and automation of processes. We give access to secondary markets. We provide a simplified marketplace on the platform, but also we use standardized protocols and ways of creating the tokens that makes it possible to trade them on other exchanges. We also, due to the degree of automation, makes it realistic and efficient to invite a lot more investors into the projects than before. And we also help increase the transparency. So basically the solution, tokenization solution like ours, and also from our competitors in the space, gives real estate developers a lot more control and flexibility over the financing process and reduces, I would say, administrative cost on the longer term, and also helps increase liquidity. Next slide. So, the value proposition briefly for real estate is to, of course, digitize and automate to increase liquidity through trading, but also the ability to fractionalize, to democratize, to reduce the ticket size and allow ordinary investors to participate, get access to different types of investors, new types of investors, make it more easy to attract international investors and also potentially crypto investors. And also, since we are using the same standards globally, it gives access to global infrastructure of investors and marketplaces, custodians, and different types of platforms that helps create additional value for the tokens that are created. The way that the system works, it's using blockchain technology so that we can use smart contracts to automate different processes related to governance and compliance, and make sure that, for instance, the international transfer of tokens will be fully compliant and sort of controlled by the system. Also the ability to limit to the ownership of tokens to certain nationalities or to a certain number of investors can simply be built into the tokens themselves, so that it's much easier to manage and to make sure that the sale of the tokens will be compliant. There's also a lot of new smart functions coming forward, such as the ability to use real estate-backed tokens as collateral for DeFi lending, so the ability to get access to very competitive loans outside the banks will be a future functionality, and also the ability to trade in a lot of different areas, including some of the new forward-coming crypto exchanges will be opened up to real estate assets as well. And also just the ability to trade with a counterparty, with someone else that you don't know, with no counterparty risk, is actually something that you can do with blockchain, and it's difficult to do without blockchain technology. It's called an atomic transfer, and it's the same technology that is used in decentralized exchanges. So overall, I would say a quite large, significant automation, reduction and removal of the human participation in these processes, and a reduction of human errors, and a lot more transparency and traceability. Next slide. There are still a lot of barriers to adoption of the space. There is, I would say, a concern about using crypto and going into the crypto world. There's legal and compliance problems in many countries where the regulation, the legal situation concerning tokenization has not been clarified yet. There's a lot of legal uncertainty in many countries, which I'm sure that Charles will speak into in a few minutes. And there's also a quite high cost on the legal side in many countries. But I would say all of these problems here are getting reduced every month as we speak. I would say solutions are coming forward where it's possible for investors to invest using normal currency like British pounds, euros, US dollars, and where sort of the crypto and blockchain element of the solution is completely invisible and hidden away. So we get the benefits from the blockchain technology without being forced to be exposed to it. And legal problems and legal uncertainties are also being clarified in many countries, including the UK. So it becomes easier and it becomes more routine also for lawyers to work in the space, and the legal fees are generally decreasing as we speak. Next slide. We as a company have around 20 projects ongoing in different countries around the world right now. Some of them are listed here, and you can look at it when you see the slides afterwards. There's not enough time here to go through each individual one of them. But it's sufficient to say that many of these companies come to us as, I would say, pioneers in their space. They like to be in the leading edge of new technology, and they are interested in trying out new methods of automating their business, getting more control over the fundraising process, the ongoing management of investors, and also to be able to offer much more liquidity for their investors. Next slide. Yeah, so there's another set of projects presented here that you can look at afterwards when you get the slides. Let's have the next slide. I think you have to click a couple more times. Yeah. So this is sort of the tokenization process in a little bit more detail. Of course, as part of the normal work that we do with our clients, we help them to understand the process here and to walk them through the different steps. There are essentially 3 different processes that needs to be followed. There's both a business, a legal, and a technical process. So the business process is about understanding how the technology and the concept here can give value, and how you can combine it with your existing fundraising process, and how the fundraise in itself should be structured for the different projects that you put out. Developing sales materials and marketing the project in itself. The legal process in itself is also quite involved and potentially time-consuming, and involves going into discussions with a lawyer, understanding the best jurisdiction to choose in relation to compliance and tax, KYC requirements, creation of an SPV to handle the real estate property or own the real estate property, and so forth. And on the technical side, which is primarily what we are involved with, it involves, of course, setting up the system, customizing it, integrating it to custodians, payment providers, and so on, testing it, and pushing the start button. Next slide. That's it for me. Thank you very much.
Thank you very much, Claus. So next up, we're going to have Charles and Alan presenting on the legal and regulatory framework.
Thanks, Vicky. So as Vicky gave me the introduction, she and I worked together on the AREF technology working group. And I'm here with my colleague, Alan. I'm a fintech lawyer. He's a funds and fintech lawyer. And we're just going to walk through some of those aspects that Claus described. So next slide, please. So here's our index. And the first thing to indicate is, what are these tokens that we're describing? This is connected to digitalization and automation. So I think we get to it in the Q&A, but one of the things to bear in mind for these projects is it's not simply a case of tokenization, the starting point is actually what user experience benefits would there be for your customers. Go on to company law requirements and the finance and fund law requirements and reach a conclusion. So next slide, please. So here we're describing tokens, and I think the key point is that whilst this is relatively new, it's not that new. And Claus has given a number of examples from the real estate sector, but tokenization is now a broadly adopted technology in the last 2 or 3 years. So I've seen tokenization projects for equity, for debt, for supply chain finance, portfolio of hotels, for whiskey, for art, as well as the real estate projects of the type that Claus is describing. So we're still at the early stages, but none of the questions are unknown, and we by and large have answers to them. The slide about tokens is making a distinction here that the FCA, the UK regulator, makes in relation to tokens. And the distinction is where the regulatory perimeter sits. Utility tokens sit outside the regulatory perimeter, security tokens inside. And the key distinction is that security tokens have characteristics of financial instruments. So they seem like equity or debt in the sense that there is recourse to an issuer, and they're often asset-backed. So when we're looking at the funds industry, we're most likely looking at security tokens. And that brings us to an important point. One of the myths around tokenization in the wider world is that it's a route to avoid regulation. It's not. It's best thought of as a layering along the top of a conventional type of fund formation project. And so in the case of tokens, we're generally looking at offering securities, the rules related to that, and requirements for a prospectus and the other supporting documents, and AML tests. So the type of regulatory questions that we're looking at are the conventional questions. You don't get around regulation through tokenization. Next slide, please. So here is our definition. So tokenization has a history coming out of blockchain technologies and references the process of adding a new asset to a blockchain. And the timeline for that is identifying the asset, verifying ownership of the asset, creating a digital representation of that asset that can sit on a platform, onboarding of investors, and that gives rise to the benefits that Claus describes there in terms of efficiency, we'd say broadly, and also the ability to bring liquidity to private markets, so adding secondary markets that will benefit liquidity. Next slide. So Alan and I are going to walk you through what this looks like, taking as an example equity in an English private limited company. And that may not be the model that is used for a particular project that people tuning in may do, but to demonstrate the fact that the same type of questions arise regardless of the jurisdiction and regardless of the entity that's chosen. We've taken the simplest model, which is an English private company. And of course, the regulatory analysis is required in relation to that, but it may likely not be different because, as we're saying, tokenization doesn't change the regulatory analysis. It adds a layer of technology with user benefits on top of it. And also there's tax analysis alongside. Next slide, please. So the issue that we come up against in English company law is that the Companies Act is prescriptive in relation to certain matters that are inconsistent with a digitalized asset. When we make a digital representation of a share, there are some aspects of the Companies Act that don't quite fit. And a couple that we pick out here. So relating to the register of members, we can see that ultimately when we do the analysis, how does tokenization fit with the Companies Act requirements, that an immutable blockchain not controllable by the issuer will fail the test of the requirement that it can be rectified pursuant to a court order. So we got a blocker there potentially in relation to digitalization. The transfer of shares, we run into an issue relating to stamp duty, that because we're talking here about a database and there is a competing database at the stamp office, in other words, the receipt and stamping of stock transfer forms, again, we have an issue there in relation to how this takes place. Next slide tells us how we have, over the last few years, solved this issue. And it will be very familiar to, I think, anybody tuning in. So anybody who's worked in the UK real estate markets will be familiar with the split between legal and beneficial title and the use of nominee companies to enable operational efficiencies of the type that we're talking about here, but that have been around for decades and decades. So a nominee company means that legal title to the digitalized tokenized shares does not change. And what we're trading is the beneficial title. So we get the benefit of digitalization with equity in an English company without falling foul of the rules that the Companies Act is setting prescriptively in that legislation. The platform is referencing the trading of those beneficial interests under English law currently. Next slide, please. So as we go through this, we map out in relation to each project the types of issues that we need to solve for these digitalized projects. And here we've got conventional points that relate to digitalization. So not just tokenization, and they are of the type that the Lord's Property Act also has requirements relating to the transfer of beneficial interests, and there are laws on electronic signatures. All of these are currently being updated. The UK Law Commission has a consultation project relating to digital assets and a parallel project relating to smart contracts, and they get these points. Other jurisdictions have already updated their rules. So notably in Luxembourg, the distinction between a digital representation of equity being placed onto a blockchain platform and the native asset, the actual asset being the token on the platform, has been collapsed by an update in the Luxembourg corporate law. So these types of hurdles that are described on the previous slides are lowered by policymakers in different jurisdictions. Luxembourg has been through the process. The UK will go through the process in the next couple of years. I'm confident of that. Next slide. So over to Alan from here for the funds.
Thank you, Charles. And I'll just pick up where you left off, which is essentially that currently the UK law is technology neutral. And as Charles just alluded to, the aim is that the UK law, like various other jurisdictions, for example, Luxembourg, would update or be updated in order to reflect the needs of a digital infrastructure such as what we are referring to as tokenization. I'd just like to start off with the first bullet point and bring our attention to the RAO, in full, the Financial Services Markets Act, Deregulated Activities of Order 2001, and just refer to that as the RAO for ease, and say that there is currently some debate over how we classify a security token as a specified investment. The leading argument is that Article 80 is the best provision or the most applicable provision because it covers certificates or other instruments representing certain securities, but there is room for other arguments depending on which vehicle you're using to carry out the tokenization. Some argue Article 89, which refers to rights to or interests in investments, but just for ease and for the purposes of this illustration, we'll just look at Article 80. I also want to stress that, yes, we're talking about the RAO and you know, the conventional rules that apply, but we shouldn't forget that other applicable law will also be relevant as well. Yes, FSMA, as most of you will be aware, will be relevant, particularly under section 22, subsection 1A, but we also need to remember that there's the prospectus regulation rules, there's the disclosure guidance and transparency rules, money laundering regulations. If the offer is made available internationally, as has already been touched on by Claus, also local laws in each jurisdiction where the offer is available, which will differ depending on the jurisdiction. For companies seeking listing on a regulated exchange, the relevant listing rules, and the rules of the relevant trading exchange or platform. Next slide, please. Thank you very much. So many will be familiar with the prospectus requirement, and we'll just look to Article 1 of the prospectus regulation. You can also find it in the prospectus regulation rules, the PRRs, but just for ease of reference, so I will refer to the relevant provision under the prospectus regulation. And as you see on the slide there, if the security token is a transferable security and the tokens are being offered to the public in the UK or admitted to trading on a regulated market, the issuer will need to publish a prospectus unless the security token is out of scope or an exemption applies. And before we come on to the exemptions, I just want to quickly flag where the tokenization may fall outside of scope. So particularly under Article 1, paragraph 2, subsection A, we have units issued by collective investment undertakings other than closed-ended. We also have under Article 1, paragraph 3, an offer of security to the public with a total consideration in the UK of less than €1 million or equivalent, calculated over 12 months. Just before we come on to the exemptions or the relevant exemptions, I'd like to bring our attention to the prospectus disclosure requirements, and essentially just to stress that information will need to be provided to potential investors so that they can make an informed investment decision. Again, most of you will be familiar with these rules already, and that the specific disclosure requirements will depend on the type of asset or security. Now, just to give some examples of the kind of disclosure requirements that will include or that of the information required, we're talking about the security tokens and underlying securities. So information around that, we are talking about the issuers of the tokens or the related securities. We are talking about the business or relevant assets and the management and investment strategy information. So again, these will look familiar because currently the UK law is technology and tokenization neutral, but as Charles has touched on, in the next 2 years, we expect that there will be even more specific or more relevant and applicable to situations like tokenization. Next slide, please. Thank you very much. So we're now just going to quickly cover the relevant exemptions. So again, you'll be familiar with some of these on the screen here. The admission to trading 20% threshold exemption, where over a 12-month period, the number of new securities admitted to trading or on a regulated market is less than 20% of the number of those securities that are fungible, in other words, mutually interchangeable with the new securities being admitted and are already admitted on the same regulated market, and that's under Article 1.5. And I'd also point out the bullet point under offer to the public, the qualified investor exemption. So solely to qualified investors, e.g. institutional, large, corporate or professional investors, which I suspect many of you on the call will be representing. And that comes under Article 1, paragraph 4A and Article 2E. The last one I wanted to flag, I just found quite interesting. It's under the offer of securities, and it's the last one there, if I'm not mistaken. It is the 8 million rule, which is the UK will not impose any prospectus obligation where the total consideration for the transferable securities being offered in the UK over the last 12 months is not greater than 8 million euros or an equivalent amount. And that's under Article 3, paragraph 2B. And you'll also find it also under Section 86, paragraph 1E of FSMA. just want to flag here, the reason why I find it interesting is because there are different exemptions that will look similar to this rule for different EU member states. Prior to Brexit, this was something that was allowed to be determined at the domestic level. So just to note that this will be different depending on the jurisdiction you're dealing with. And I'll just hand over back to Charles. Thank you.
Thanks, Alan. And we've used that one a lot, the €8 million exemption for small projects and technology-driven projects. It's been a very common exemption to use. We're seeing it used less now as the projects are scaling in size and more institutional participants in the market are doing these kinds of projects. So Alan and I we were chatting about how we describe this, and mindful that lawyers talking about the law, there are some pitfalls in retaining people's attention there. But the thing that we particularly want you to take away from this is the work has been done. So these issues are now relatively well understood, both the issues, how they play against conventional structures, where the exemptions are, how to map out the technical analysis and build that into projects. So the main thing from our section is, if you call your lawyer and say, I want to do a tokenization project, they won't look at you blankly. And they won't say, well, that's interesting, we'll get a blank piece of paper and start from scratch. This has been work that's gone on for 2 or 3 years, and it's now relatively well established what the rules are, how they work, how they interrelate. So that's our summary of the rules, but we wanted to talk you through that so that you could see what the technical analysis looks like, and hopefully reassure you that it's not something that looks different to the analysis behind other projects. So our conclusion, why do it? We're pretty keen on the technology, and we've both got a background in that, but really the thing to aim for here is providing better user experience, so better engagement with your customers, engagement with new customers and new types of customers. So if you're able to see that as the prize, then to us that seems to be a reason why it's worth doing. So what are we doing? We've got new technology sitting alongside old regulations. That does give rise to some tensions, but we've already identified how to do it. We've got the maps of it. We know how the workarounds operate where required. And how do you do it? So I think all of us on the call would be able to share timelines and document lists and similar, but again, hopefully this list identifies those aspects that you would start with in any fund formation project. You identify the commercial aim, you go through the choice of vehicle, tax advice that makes it work. A service provider is a new thing in this world because you would work with a technology service provider such as Claus's firm Digishares. Other providers are available, but Claus gives an explanation of what they do. And then our final point, summarized by the famous Mark Cuban, who's made a name for himself recently in crypto investing. We give you links. You can go and have a look at Enzyme. I think we might have spelt it wrong. It should have a Y in it. And D-Hedge. We'll get that recirculated. On the point that Claus makes about DeFi, decentralized finance, we've now got fully automated asset management projects running on smart contracts. And you can go to those links, we'll get you the right links, and have a look at them. It's mind-bending stuff, I think, even for people who've got some background in smart contracts. And this is potentially where the market is going. So it shows you what you would be aiming for in terms of what customers are seeing. And that's us.
Okay, great. Thank you very much. Who'd have thought the legal section could be quite so interesting? So moving on now, we're going to have Adi from Applied Blockchain going through his experiences and understanding about what's going on in the fintech industry, and hopefully we can apply some of this to our real estate learning. So when you're ready.
Thank you, Vicky. You're right, I didn't think the legal part would be a hard act to follow, but I think it is. So my name is Ben-Ari. I'm founder and CEO of a company called Applied Blockchain. We've been developing blockchain smart contracts, smart contract applications in the space for about 5 or 6 years now. My background is technical, and before starting the company, I was working for Lloyds Banking Group on their mortgages applications, among other things. And when we started the company, we engaged with sort of a number of large corporates in integrating blockchain and building blockchain applications. And what I wanted to do here is really take you through a little bit of our journey, because I think it reflects some of the way people understand the technology, the assumptions that people make about blockchain, but also some of the things that that we see people commonly get wrong. And so I think it's worth clarifying some of these points. So first of all, in terms of the basics, the way we look at blockchain is as a security technology. And I mean security as in looking after things and make sure things don't go wrong or get stolen, rather than securities law. And the benefit that we see that it brings is group security, right? And it's group security of historical records, which in particular is interesting for ownership records. So who owns what, and who owned what in the past, and do they have the right to transfer to me this thing so that I can now own it? And so what we have is we have a group which can look after those records, we believe, in a more secure way than if it was a single party looking after those records. And that's the underlying core benefit of this whole technology. So if you're looking at an application, even an application of blockchain, where there is a single party which is in charge, and that party can effectively make changes to the records, then you probably don't need blockchain. Right? The only time we think you need blockchain is where there is a group of parties who together are making sure that the records are safe. And once you have this as a basis, then there's a lot of interesting things you can do on top, because you have these ownership records, and you can write business logic as code on top of these digital ownership records, and that can make things very efficient in terms of business processes, in terms of transfers, and so on. And that's really why this is being looked at for this industry. For real estate, in terms of the ownership records themselves, we have the ownership record for the property itself, which is the land registry. And the land registry has been undertaking some initial pilots, which have been publicized, looking to digitize these ownership records in a way that they could be stored on a blockchain. The second way of looking at this is funds, which is obviously what we're discussing here, and then it is up to the fund how those records are held, obviously within the law and within the regulation, as we just heard earlier. So that's really where we have more flexibility. I guess the other thing to note is that when I said earlier that it's really about group security, it's also about group interaction. Because again, we've seen many blockchain implementations which are set up as quite closed. They're closed environments, they're closed exchanges, and that's because they want to ensure that they're compliant with the regulation and that all the rules are enforced by a party that can report and abide by the regulation. However, the benefit of the technology really comes when things open up. So what we see in things like decentralized finance, DeFi was mentioned earlier, is we've seen an explosion in activity on the public blockchains. And these are, if you've heard about them, Bitcoin, of course, and Ethereum. Much more so Ethereum, because on the Ethereum chain you can code, you can add these smart contracts, which are the coded business logic on how these tokens can move, and you can have different applications that talk to each other. As an example of what we're seeing in other industries and what we've been involved in, we now have artwork, for example, and different types of collectible items, which are being digitized in this way. So there's a marketplace where you can buy and sell the digital artwork, and you can trade it with others. But beyond the marketplace that's set up, you can take this artwork, first of all, to other marketplaces, and it's all compatible and interoperable through the same blockchain network. And you can take your artwork, once it's been bought and sold and has some value associated with it, which is even recorded on this blockchain from the previous transactions, you can take that to a decentralized finance application, which can then take that digital artwork as collateral and release funds to you on that basis. And this is all fully automated through these digital contracts. So this joining up of different applications that are being deployed by different people for completely different reasons in completely different markets, because this is all digital and open, you can just plug these things together and take something from over here and send it over there. And that's only really possible on these public open blockchain networks. And of course, they come with the cryptocurrencies as well, which is where a lot of the complexity and regulation and so on come in as well. So this is a general direction that we're seeing. We're seeing projects move much more towards public blockchains as opposed to private and closed and controlled ones. And we're seeing tokens and applications which are much more interoperable than they were before. I think these are the main points I wanted to make. I hope that's useful.
Okay, great. Thanks very much. We're now just going to move on to our Q&A section, and we've got just over 50 minutes left. We've had a number of questions through so far, so I won't hesitate. We can just get going with these. If you've got other questions, please do send them through the Q&A function, and we'll get around to them if we get the chance to. So the first question that we've had is, what does the blockchain give us that we can't get from digitalizing our current process? I'll pass this one first off to Adi, given your experience, and then if any of the other speakers want to add to this, please do feel free. Adi, were you able to hear me there?
Oh, sorry. No, I was coughing and I missed you. Sorry, can you repeat that?
No, not a problem at all. So just saying, first question that we've had here, which I'll pass to you to answer, and then if other speakers want to weigh in, they're very welcome to, is what does the blockchain give us that we can't get from digitalizing our current process? So
I'll go back to the first point I made, which is the security. Where you've got assets there that are being stored by one party in a single place, then there is a security vulnerability there. That is that you're completely dependent on, first of all, the security provisions of that entity, the honesty of their employees, and their policies and enforcement of their policies and so on. Now, that's the world we've lived in up to today, and to some extent it served us well, but it does leave us vulnerable to some extent. Blockchain brings another level of security here, in that you've got a group that's together making sure that these records are not being tampered with. And that's much more powerful, especially when you're dealing with high value assets, as you are in real estate, of course. So if those records were to get in the wrong hands, or someone were to go in and change them, or some employee were to commit some fraud, that could happen with a regular setup and could take a while to be detected, whereas on a blockchain that would be much more difficult to perpetrate. That's one side of it. The other side is this interoperability with this new world of financial service applications, which we're starting to see emerge, which we referred to earlier, DeFi. Okay.
Thank you, Adi. Klaus, Charles, or Alan, have you got anything you'd like to add to that?
Yeah, I can add just a few words. I agree also with Adi that the main point is really the interoperability. So you can get pretty much the same benefit out of normal digitization if you have a siloed application. So a closed application where all the projects are presented and the investors can invest and so on, gives you some of the processes, right? But it doesn't give you the ability to connect to all the other players in the ecosystem. And that's really where the majority of the value in the future will come from, and the major part of the innovation.
Yeah, I'd say exactly what they're saying. So from experience, I think you get benefits from a digitalized process. Obviously, taking manual and paper-based aspects out of these platform processes are a benefit initially. There are additional benefits from tokenization that doesn't need to use a blockchain. It's an extension of digitalization, with apologies for all the izations. And then if you add a blockchain layer on top, then it does the things that Addy and Claus are describing. So it's a kind of, you pick the one that you want, and that's a combination of technical appetite and also the functionality that you're looking to provide to users of the product. And we do see people who are jumping right to the end and saying they want to do a blockchain product because they think that the market profile is going to be beneficial as well. So there are, like lots of innovations, there's a bunch of trade-offs, and you kind of work your way through the trade-offs. I think we're all on LinkedIn, and in particular, people should get in touch with Claus and Addy because they're good at the commercial trade-offs, and they will kind of dig in and say, what are you actually trying to do? And then people who do what they do can tell you the best way of doing it. So you're not, you're only adding the efficient bits. You're not doing things that you don't need to do for the commercial end.
And just following on from that, how important is it so if you've got investment managers that start wanting to use this technology, how important is it for those investment managers to fully understand this technology?
I'll have a guess. I think for Addy, because he does this for a living. So I think I'd say in the same way as any onboarding of an IT vendor or IT supplier, you would have questions about the robustness, the security, all the things that my regulator now talks about in operational resilience, using that umbrella term. So I think it is like that. We'll see if Addy agrees or disagrees. I don't think it means that you have to be more nervous or more thoughtful, but I know there are people who are listening into this who are experts, and so you may find before you reach that conclusion, you should probably check whether you've got any colleagues that are experts. I know Nakash has dialed in from PGIM, and he is a kind of leading expert in the world. So his firm have got access to his own expertise, and lots of firms may find that they've got internal expertise as well. But over to Addy.
Yeah, I think you should be nervous about this because it is a relatively new technology, and there are there are statements being made out there which are not necessarily accurate, or depends on context that you take them in and so on. So I think it is useful to have a good understanding. Take for example the security that I talked about. It's only security of the historical activities in the ledger. It's not access to the data itself. It's also not the actual custody of the assets. Custody of the assets sit with what we call private keys, and there are different models for who handles those, who they sit with, and therefore who has control of your assets, and how they can be moved, provisioned, or stolen, right? So I think this does require. This is a different model. It's a different paradigm. It's not just a bit of IT. It reaches a bit further than that. And so I think to engage with this, unless you really are taking a completely off-the-shelf solution from a vendor that you absolutely trust, if you are piecing together something, or you want to do some due diligence on a type of solution, then I would suggest getting some expert advice, because it's not that straightforward, and it is relatively new. So I think there are still some misconceptions and pitfalls.
Okay, thank you. Another question we've had in is, and I think we'll send this one on Claus's way. It's, what are the practical uses for tokenization within real estate? You covered a little bit of this in your presentation, but I wonder if you want to add more.
Yeah, so it ties into the same question with digitization. So a lot of it is just the ability to digitize and automate processes, which I think you can also do with other technologies, but you also get it with tokenization. You get the ability to automate a bit more because you can use smart contracts to automate processes related to purchasing of the actual securities and trading of the actual securities using smart contracts to sort of remove the counterparty risk when you trade. So you get a bit more automation that you would otherwise get. And then I'd say you get the ability to get your own marketplace where investors can trade. And you also get the access to the entire ecosystem, which in the future will give you access to hopefully inexpensive DeFi loans and also a lot more liquidity. Access to trading exchanges where some of them will be focused on real estate and where a lot of liquidity will be available. Yeah.
Okay, thank you, Charles. We've had a very specific question in for you here, which is, in your opinion, which countries provide the most competitive legal and regulatory framework for blockchain and tokenization?
So I'm a lawyer, so we'll assume that I've already said it depends. The question is somewhat dependent on the type of project that you're doing. So a crypto project, we might give a different answer. I think the offshore jurisdictions that do this fund formation work are on their toes in relation to this. They recognize that this is a market opportunity for them, and they can see that this is the business that they facilitate coming through. So Luxembourg is entirely familiar with this as a European jurisdiction. Switzerland is familiar with it because there's been a lot of crypto fund formation there. Jersey, through Jersey Finance, its trade body and other, the professional community there is familiar with this, although they've got a shorter track record, I think it's fair to say, than Luxembourg. And Cayman and BVI have both done a fair bit of this work. I think Cayman slightly more than BVI. So any of those, I think, would be familiar jurisdictions to the people listening in on the call. And that would be, from mine and Alan's perspective, I think the key point that we're trying to get across, that if you are talking to your usual advisors, this wouldn't be unfamiliar to them, and they can walk you through it. When I said it depends, the distinction is in the funds world, I think people are generally trying to replicate more or less conventional forms. In the crypto and DeFi world, people are trying to do the opposite. They're trying to drive innovation, and therefore we've got other jurisdictions that can be easier to operate because they're a bit smaller and therefore quicker to approve things. People may have heard of Malta and Gibraltar being strong contenders for this. I think that's true, certainly in crypto. So the short answer is talk to the jurisdiction that you would normally talk to, because they would be able to manage this. And I can pick up, there's another question I see from Ben around how the rules work relating to syndication. And the practical point on that is we're not confident enough yet to do these transactions as part of an acquisition. So I think his point is, do you acquire the asset into an SPV and then go through the tokenization process, so kind of warehousing, as we call it in structured finance? The answer to that is yes, simply because we're not necessarily so predictable on timing that a seller would wait. It's probably worth just making the distinction around tokenization of equity and tokenization of the underlying asset. The reason we tend not to tokenize the underlying asset, and let's take UK as an example, as we did talking about equity, is there is already a database and it's HM Land Registry. The Land Registry is going through its digital street process. They will get there. in terms of digital adoption, I think, again, in the next couple of years. But for now, the distinction that's made with equity between legal and beneficial ownership means that we can do tokenization of assets. You can have a nominee owner of the asset on the proprietorship register and then do the beneficial title held across a number of syndicate members behind that. But it tends to be more common to do tokenization of equity just because that's more familiar. The documents are set up, the precedents are set up more to do that.
Thank you. Another question we have is, how will this technology affect high net worth clients and even DC clients that want to access unlisted real estate in the future? I don't know who would be best to pick this up. Maybe Charles, or
Claus, because I think that all of his clients on those projects that he's got in his slides, well, not all of them, but I suspect a number of them came to those projects with exactly that aim commercially behind them.
Yeah, it's a good question. I think that actually the effect will be more on the retail investor side, making it easier for them to get access to real estate assets and diversify their portfolio into this field. I think on the high net worth individual side, of course, maybe they'll be able to spread their investments over more real estate projects in the future compared to now, and certainly it will get a lot more liquid for them, so they'll be able to much more easily liquidate their positions in different projects with lower cost. So, yeah.
And I think for both sides of that market, it's a benefit to the secondary market. I think the most recent statistic I saw is the secondary market for private equity funds is $85 billion, I think, dollar markets, and that's from a position where 10 years ago it was relatively unusual and very bespoke to do LP transfers in private equity funds. This is part of that general trend towards increased liquidity. It's where that phrase democratization comes from around these assets. So Claus is describing it in terms of reaching retail investors, but also it will drive liquidity around secondary markets and all of the benefits that liquidity brings to private markets that develop secondary markets in terms of price discovery and all of those commercial benefits as well.
Charles, I agree. I mean, I think the secondary market and that liquidity is sort of the main benefit here. I've got a question about the tokens, though. I mean, how are they treated in the secondary market, and are there further restrictions there, or can they be traded anyway?
So that's part of the analysis that Alan's describing there. So the reason for going through the conventional fund analysis and establishing a project is to enable the trading of these assets in the secondary market. So there are choices to be made around the level of trading that's required. Less trading makes it easier to get inside one of the exemptions. More trading means you're more likely to require a prospectus and have to go down that offer of securities to the public. So again, I'll let him come in. Actually, I'm speaking for him. So I think it's an example of the technology is an enabler, but it's a layer on top of the existing rules. So whatever you could do before. So
before it comes in, I mean, this is where the friction is really from our perspective, because if we look at the DeFi markets, they've gone from being worth almost nothing to 100 billion in about 12 months, right? And this is because anyone in the world can just pour into this thing, transfer their crypto, and there are no restrictions. And that's brought this tremendous growth, tremendous liquidity, tremendous innovation, and we're seeing the mechanics of all of this working. Of course, as soon as you start, blocking those people or severely restricting access to those larger numbers, there goes the liquidity, right?
So if I had £1 for every person that's got in touch with us saying that they want to access this liquidity in the crypto markets, issue a token, and then unfortunately want it to be asset backed and use it in a business, not as a kind of ICO style utility token where it's a credit for a technology project, I could launch my own fund.
Those pounds should be your liquidity, right?
Exactly. So we're still, I mean, the regulators are struggling with DeFi for the reasons that you've described about the speed that it's scaling. They are pretty attentive to it. At the moment, we just have the on-off ramp where people are coming in and out through fiat and the AML tests around that. Any projects that we're involved in get KYC'd. I think we're in the traditional regulated markets, and I think anybody who is has to go through their usual onboarding processes to be able to work on these projects. But I think the regulatory view of the Ethereum project and smart contracts means that the regulators are trying to find a way of engaging with it. I couldn't tell you what it's going to be yet, but we can see that this is on their radar.
But on that basis, sorry, go on.
We are running out of time slightly, Eddie, so we're going to have to close it here. But if you want to make your final remarks, and then we can close off.
If I could just come in, since I think there was a question posed to me. I think it depends, first of all, on the jurisdiction, number one. And without just trying to avoid the answer, I think it also, we would also need to bear in mind that tokenization, yes, there are benefits in terms of liquidity and democratization, but tokenization is not a way of avoiding the regulation. And that would be my position at the moment. I think, as Charles alluded to, we're yet to see how the UK plays out. And I think in the next year or 18 months, hopefully the review will provide a bit more clarity on questions like this. But the general position would be that tokenization wouldn't be a way to avoid the regulation, and it would vary according to the jurisdiction that we're working in. Hopefully that helps.
Time for me to add a few comments.
Oh, okay, yeah, sure.
There's actually a single UK-based exchange starting up called Archax, where it will be possible to trade security-based or real estate-backed tokens in the future. But it's a highly regulated market, as Charles is also saying. So they have obtained an MTS license, and it has taken a long time for them. So as opposed to what we see in the DeFi ecosystem, it's a regulated exchange with KYC and sort of a lot of friction built in. So not the solution to get the same kind of liquidity, I don't think. But there are also a lot of initiatives of trying to sort of somehow build DeFi trading facilities and so on with whitelisting built in, so that the KYC restrictions are followed, and so that it can be in principle compliant. Yeah.
Okay, I think we're gonna have to close it there because I'm being told that we've run out of time, unfortunately. But that has been a really interesting discussion. I'd like to thank all of our speakers today for attending. We've got a couple of questions which we haven't yet answered, but we will discuss these as a group and try to come back to you offline on those questions. But I'd like to thank everyone for attending today, thank our speakers again, and I hope you all have a lovely day. Thanks ever so much.